Welcome back to the Paperstac Podcast. My name is Rick Allen, TJ Osterman. Got the Jumpstart guys back here with us. How you guys doing?
Great, man.
Yeah.
Good to see you guys again.
Yeah.
In person.
In person, in the flesh, right? We're here at the PaperTrail Conference in, where are we? I guess Chandler, Arizona.
Beautiful,
right
hot,
outside.
105 degree.
Oh my gosh.
Chandler, Arizona.
I was just looking, we came from Florida, and I was looking, I was like, oh, we're going to get a break in weather, no humidity, and I looked at it, and I sent them a text. It said 105. I was like, oh, this is awful.
But it's dry heat.
So they say.
That's what they
yeah,
say.
exactly.
It's
not a dry sweat, however, unfortunately.
Yeah, right? It's 105.
Well, it dries by the time it's sweat.
Well, yeah, we're excited to have you guys back. Man, we got tons of people reaching out about our last episode we did with you surrounding business notes, and TJ's been diving head first in on this deep, and he's got a lot of great questions from people that are listening to the platform or listening to the podcast, and people on the platform that are interested. So
Great.
Yeah, and I think a good thing is this is kind of your guys' first note conference, right?
Yeah,
So you guys have been exploring around a little bit, talking to people, self-directed IRA. So there's a lot of dry powder, we call it, or money sitting on the sidelines looking for different opportunities. And I think that's where this kind of opportunity came about with the business notes. And it's a lot of the stuff that I'm getting back from people is, why would I buy a business note if it's the same work or maybe even more comparative to mortgage note?
Yeah.
So it's I know that was some of these things that we're learning from people and trying to get them off the sidelines to, let's diversify and let's buy these things. So how do you answer something like that? Why wouldn't somebody want to buy a business note comparative to a mortgage note?
Yeah, and it's a great question, and one of the folks we were talking to today, one of the self-directed IRA guys there, had be the bank, be a private lender without becoming a bank. And in general, this idea of being able to buy a note and be able to see principal and interest and see returns with an underlying asset is just such a great opportunity for the average investor, whether it be an individual or an institution or a fund or whatever. But as we know, and we're learning this being at this conference, which is really, really great so far, mostly people go to mortgage, lending or some sort of asset-backed type of lending, and that's something that people are really comfortable with when it comes to buying notes, whether it be in first or second position, whether it be performing or non-performing, whether it be multifamily or single family or commercial. And so what we're finding as we're having conversations is, hey, that's not the only kind of asset class out there when it comes to lending, right? You think about it, we probably have car loans, we have credit cards, we have a mortgage, we have a variety of different kinds of loans, and so those are the loans that are out in the market as well. And if you can invest in one type, the mortgage, you could also invest in other types of loans. And as you say, one of the things that we see as a huge opportunity is a business note, and there are a few different distinctions that make it different. In some ways, we think advantageous over mortgage or real estate backed notes. When you're buying a mortgage note, you're buying what a lot of the people here are very accustomed to buying. What is the underlying asset behind that, and how can that asset potentially fluctuate in value? And we all know that it can fluctuate rather wildly.
Oh, yeah.
And often
that's the
unpredictably.
big question.
Right?
Is people asking well, I'm buying a loan on a business.
Yeah.
What am I buying? What's backing it up? Hopes and prayers or business plans? And it's actually it's more than that, right?
Yeah, because think about it. If you're buying a mortgage note, there's somebody that's paying that mortgage, right? And if it's residential, then it's an individual that has a job that is paying the mortgage, and that individual, essentially you're sort of betting on the jockey, the person that's paying that mortgage, to be able to continue to do so. They're at risk of losing their job, they're at risk of having a health crisis, they're at risk of a lot of different things happening. When you buy a business note, however, or because we originate business notes, so we're right at the point of origination, we're not looking at the individual as the source of debt repayment, right? We're looking at the business as the source of debt repayment.
Interesting. Yes.
Unless you're talking about a pure startup where we are relying very heavily on the jockey, right? But even then, we're looking at projected revenue and cash flow. We're expecting the business to be able to service that debt at some point.
Yeah.
But when you're buying a business that's been around for 10, 20, 30 years, like so many of these amazing baby boomer businesses that are going on the market, you got 75 million baby boomers are part of this silver tsunami that are going to want to retire. Most of them are going to need to sell their business. They may have kids. They may have kids that don't want to have anything to do with the business, or they may not have kids, right? So there's just this huge demographic time bomb that's ticking with all these great businesses that are profitable, that are cash flowing, that have been around forever. I would rather bet on one of those as the source of debt service than bet on, a homeowner. I'm talking, of course, about residential, but it could apply to a tenant in a commercial.
Kind of against that market, like the overall residential market, because a lot of people we're talking to now are like, great, I bought this loan last year, 50, 65, 75% loan to value.
Yeah.
That value is now, we're projecting out 10 months, 12 months. Is that going to be up to now at a 90 to 95% loan to value? Is
right.
the market?
Yeah.
And so there's that uncertainty that I think, granted, the overall economy could affect a business, right? But at the same time, that person still needs to make money and support himself, so he still has to run this business, and business isn't going to completely go under, right?
Correct.
Well, you've also got historicals, right?
Exactly.
So you can look at the business and say,
Correct.
I assume most of this stuff is on pre-existing businesses that have,
Yes.
like, look, there's data here. It's not like, hey, TJ and I are going to start our own taco shop out of a, out of a food truck.
Yeah, that's a different
That's different.
vehicle.
We are interested in that, though, by the way.
Correct.
Yeah. So this is
There's
really
history data.
Yeah,
Yeah.
there's historical data there,
Yeah.
and somebody it's just a changing of the ownership, right?
Yes, exactly.
As long as they follow the plan, they still doing what they're doing. The food still gets made.
Yeah.
If it's a restaurant or
Yeah.
whatever service business, it should
Yeah,
keep
what were you
going.
going to say, Nick?
And one of the points you were, I think, alluding to before was when people think about this space and notes and mortgages, then they're thinking, well, it's secured sort of by the property, right?
Right.
And then you think, okay, well, this business loan, what's that secured by? Well, obviously there's the business, which we do, UCC filings.
Yep.
But then there's also the personal guarantee side of it as well, right? A lot of people may not understand what that really means. But at the end of the day, it's not just about the business and what if they're not going to pay, what happens. Because anyone in the note space and the mortgage has that same challenge, right? Like, what if they default? What if something happens?
Sure.
So at least from the business side, you still have that. There is security with personal guarantees and other things. That,
Yeah, and I think
Yeah.
that's a great point, because I think people will look at something and say it's unsecured, and it's like,
Correct.
what does unsecured actually mean?
Right.
You were just telling us,
Yeah.
like, if you don't mind going into a little bit of a case study, you don't
Yeah.
have to get into the details, but we were literally just talking about this because there's people, and this was news to me, people were, hey, I'm looking for non-performing business loans. Like, why would you even want, I can't imagine why you would do that.
Yeah.
But then you were like, well, we just actually got a judgment on one. Can you share a little bit about that?
Yeah, and I think just to build real quickly on what Nate was saying too, there's layers of recourse you have with a business loan that you actually don't have with a mortgage note. And we're not denigrating mortgage notes at all. It's a great investment for many, many investors. But you've got the UCC, you've got the business assets, in many cases you've got business real estate, you've got the PGs, and then you might even have personal real estate. So you're able to
PG's personal guarantee.
personal guarantee, yes, thank you.
Yeah.
So you're able to go after the borrower or borrowers on a number of levels. And so what we found, we had a note originated a couple years ago. It was a franchise purchase, which is essentially a startup. And what we do in that case is we look very heavily at the jockey, and these were two jockeys. They were two business partners, had very, very high credit scores, had great liquidity, had great personal income. There was income that was going to persist beyond the purchase of the franchise, had real estate. And so we didn't, to your point, it wasn't secured in the sense that it was real estate backed and there was an actual lien on property. However, it was personally guaranteed and there was a UCC blanket filing on the business. So they got into some legal difficulties with the franchisor for whatever reason. Since I'm not naming names, I can say that they probably just didn't work hard enough to make it successful. But so they, got into some litigation with the franchisor, and they decided that they were just going to stop paying the loan. And so it was about $200,000 that had to come from somewhere.
Yeah.
And so it needs to be repaid, right? So what we ended up doing is, and one of the things we found as a lender, as a private money lender, when you stop communicating with the borrower, stops communicating with you, that's when the troubles begin.
Yeah.
So we always try to work things out. We try to find ways of modifying loans. We try to find ways of working on, say, pay downs with re-amortizing the remaining balance, maybe some partial relief for a period of time. And again, these are other ways of mitigating the risk on a business loan. We can work with them, understanding that they maybe are going through a difficult portion. So it's not just like it's over and it's done, they stop paying the mortgage and now we have to go foreclose, right? It's a different dialogue that happens with a business owner. Getting back to our folks that decided it would be a good idea to just stop paying the loan, stop communicating with us, because of the covenants and the loan docs that we had in place and the personal guarantees, we were able to file a lawsuit. We were able to obtain a default judgment, and then we were able to domesticate that judgment to the state in which they live. And because they had very good liquidity and assets and high income and owned homes, we're now able to go and attach to those things and levy and garnish and repossess a couple of free and clear. We don't know what vehicles we're getting yet, but they're free and clear, so we'll be getting them. So at some point, though, in this process, what typically happens is people like that who don't want to just trash their credit, they're not in a position to declare bankruptcy because, you have to obviously qualify for that. They're just going to pay. I mean, they're going to pay. They're going to start to come back to us and say, okay, what do we have to pay you for you to stop collecting on it? And so it's just a good example of, yes, it's a little bit of a different process beyond foreclosure, but there's a lot of stages to it and there's a lot of dialogue, and at some point the recovery rate on these kinds of loans is actually quite high, once we get into it.
I think one of the things that me being an investor in mortgage notes and Rick and other people is like, okay, when that divorce happens or whatever happens and this thing stops paying, what type of support? We buy a Jumpstart loan, right? We love it and everything's going good. You guys are servicing it,
Sure.
right? Which is a benefit because these things happen.
Yes.
I need you to walk me through this.
Yeah, exactly.
I need help. I'm scared. I invested retirement money that I have in this thing. It's my first deal here.
Yeah.
And it's like, to me, that's what I want to know. I want to know, do you guys have my back? Will you walk me through domesticating the judgment? People are like, what in the
What the heck does that mean?
And so it's like, to know that, and to know that you're able to do such things and to let people out there to know that these business notes, you can be more nimble. It's not institutional. You can work with this borrower.
Correct.
You can, because you want it to pay.
Yeah.
You don't want the conflict. You want conflict resolution.
And
right? So,
and to add to that, just on the front end, it's all about risk mitigation, right?
Yeah.
So what we're doing is we're the ones underwriting the loan from day one.
Right.
So when we're assessing this deal, we're right in the heartbeat of it, right?
Yeah.
And again, just as a difference to mortgage notes on property, someone buying it, as a second or buying it wherever, they don't really know a lot about it, and then they get into it and might go, well, I wasn't quite sure of this. I'm peeling back the layers of the onion now. I've bought this note and I didn't realize that. Because we underwrote the loan in the beginning, we know everything about this loan as well.
Right.
So that just helps with risk mitigation.
Underwriting
Also
is key.
The type of, it's different when you're going to collect on somebody's house, right?
Sure.
It's their house.
Correct.
This is like if the house goes, there's probably not a lot else behind it, right? Or they would save their home. If somebody stops paying in the instance there, it's a business decision. They're like, maybe not a great business decision, but they thought, hey, I'm making a business decision. We're having problems here. I'm just not going to pay there. At that point, there's probably more behind there. You guys made a loan based on not just the business, the jockey also. Hey,
Right.
My dad's an attorney. He says you always plan for the divorce.
Yeah,
right?
Yeah.
You always look at like, hey, worst case scenario, if I gotta go recollect this, how are we gonna do it?
Yeah.
When you go to originate the loan, you guys are saying, look, there's a plan A.
Yes.
They're gonna pay, but there's probably a plan B and a plan C.
Absolutely, yeah.
Yeah, and I think the interesting thing is this borrower probably thought what most people that would buy this note would think. If I just stop paying, it's unsecured. That's what they told me. I saw the paperwork.
Right.
There's no repercussions.
Sure.
Hence, most of the buyers that I've been talking to, investors, well, TJ, if they stop, it's unsecured, but what am I going to do? I'm going to be out my money. You know what I mean? I just bought this thing. So I think it's a microcosm. What this borrower thought is the greater of what investors looking into this space are thinking.
Yeah.
And it's not true.
Guilty.
That's
Me too.
Guilty.
I'm learning right now,
Yeah.
and I'm going through this going, I love that.
Yeah.
I like that, because that's a good, I can do that record. I like getting that. Let's get it going.
Correct.
And if we need to get them re-performing again, fine, we'll work with you. But if you're just totally ghosting me, then I'm going to come after you. It's ridiculous.
It's hard to squeeze blood from a stone, right? If somebody's lost their house, and we've done it, we've been there, we've done through the foreclosure, or going through
100%.
loss mitigation. People are like, I just want to keep my house, I want to work with you, and I'm like, you don't have any money. You're not going to be able to pay this.
right.
Different if you're like, give me somebody who's got some capital to be like, hey, let's make this work.
Yeah.
Let's figure out a way to work through this, or we're gonna get the money. We just got to figure out how it's gonna happen.
Yeah.
I'd much rather work with somebody like that, especially because it's not personal relationship. It's not, they don't have emotional equity in a house. It's like, hey, this is a business.
Yeah.
And even to add your perception around, well, this loan's unsecured, so it's a higher risk.
Right.
It's an interesting, that's not quite the case, right? Now, without getting into the legal side, when you think about a mortgage note and you go, well, the collateral is the home, right? That's it, done. Whereas when we're doing the business loan and we have this PG, personal guarantee, it's almost like a blanket. So it's, if they do have a personal
what all
home.
do you own?
Correct.
Yeah,
right.
exactly.
So again, without getting into the legal
Yeah,
side,
but
it's
you're doing
actually
that right at that underwriting
it's
level.
more of a blanket level.
Correct.
So
Yeah.
if they did have other things that we can leverage, that's actually an advantage.
Yeah, and I would just add one thing that you said, coming at it from an investor perspective, and you had mentioned, guilty as well. Like, that's the way I thought about it. So one of the things we would emphasize is that overall, when you look at our sector, and you look at business notes, and you look at these in terms of apples to apples with other types of originated business acquisition franchise notes, you see a trend that puts the default rate well south of 5% and closer to kind of 2.5%.
Wow.
It depends on sector, depends on, restaurants
Sure.
are a little bit higher, construction might be a little higher, but so overall, we're underwriting to those kind of loss expectations, which are really very, very low, right? So that's the first thing that we would say to investors, and that all comes down to the rigor of the underwriting, and because
That's the default, you said.
default rate, and
Yeah,
not
that's
even
the default. That's not recovery.
and recovery makes it even lower, right?
Yeah.
So, but if you look at an investor, yes, if you go and put all your money, $200,000 that you've saved up, and you go buy a $200,000 business note on one business, you are taking a greater potential risk of loss if that one business note goes south, right? Even though, to your point, we would work very closely with them as a servicer, and collect with collection partners and attorneys to help recover that. But if you've got $200,000 to invest and you put it in 2 notes or 4 notes, that's the beauty of being able to spread the risk. And we're not talking about pooling these into a fund. We're talking about literally saying, I like that business. I know that franchise because there's one on my block, and I really like that. Oh, and this business is really interesting. I know that's growing because I know what's happening in the economy. So I'm going to buy a portion of each one of these notes. And so, we can do partials or participations on these notes. It's not SEC regulated in the sense that it's a pooled fund. You're relying on a money manager or somebody else for performance. You're literally looking at the underwriting documents. You're looking at how the loan has been put together, and you're saying, I'm going to put 50 here, 50 here, 50 here. Now, one of them could go bad, but you're by definition mitigating your risk. And that's one of the investment strategies we would recommend people pursue when they're putting their foot in the water and just kind of like wanting to learn about it and see how it works.
It's interesting because I know, Rick, we were talking about this back at the office, and when you're selling a business note, is that a secure? Because we've been through it with Paperstac. Like, what type of licensing are we going to get in trouble for security?
Is it security?
Are we because you have to protect, but it comes down to there's that participation. It's a whole loan, but then you can participate. And what you're telling us is that it doesn't pop up any red flags where that's a security because it's not put into a vehicle. Then that vehicle then isn't being sold or like somebody is managed.
Yeah, widely distributed loan participations are not securities, and that's
because if you were to type it into, and a lot of times they'll come back with the safe answer if it is.
Exactly. I mean, it was J.P. Morgan Chase was involved in this outcome, this legal outcome. I think it's 2024, fairly recently. And that's because I'm not an SEC expert here, but generally speaking, what happens is if you yourself are making a purchase of a whole loan or part of a loan, and you're directing your own funds into that, and you have the kind of visibility that people have through your platform, for example, into these notes, and you could do your own due diligence, you're buying a portion of a contract and a portion of a loan versus we also have a loan fund, by the way, Reg D 506C SEC registered loan fund, which is you putting your money into a pooled fund and relying on a fund manager who's making investment decisions on your behalf, and you're expecting a return.
Hence SEC, that's why you went down that road.
Exactly. Yep. So there's really two distinct things. But the beauty of notes is that they are not securities if they're marketed and sold in the right way, and it lets you, involve non-accredited investors. I mean, typically we work with sophisticated investors who know what they're doing, but they don't necessarily have to pass the same, accredited milestones.
So that's interesting because Jumpstart has a great portfolio of current notes that we're marketing. It's trying to sell these things.
Exactly.
But people that want to buy a little piece of this business. And there's a little bit of sexiness to it too, because mortgage notes, we loved it. It was like a new thing when we came from the fix and flip space. Like we're buying debt. I used to love to tell people that because I felt like
debt.
They're like, wow, dude, just get buying debt, trading debt notes and stuff. I'm like, it sounded great. Yeah. It sounded cool. It's a diversification play. And then now I think it's a little sexy too because it's people like business. They like to transact business. They like to buy into business. Not everybody's a venture capitalist that can throw $100 million.
Yeah.
But that's a sexy thing. I'm a VC. You're like, wow, dude, this guy's a VC. Now, in a way, they are at a small little level. Yeah. So it's democratizing, I think, everybody else out there to where it's an untapped market. Like, I'm a VC in this a fund of, like, we have 20, what do you have, 20 something?
I think we have 25 loans
25
now,
notes.
right, yeah.
Diversify and how we can help that process.
I think it's just like when we started buying notes. It was like there wasn't Paperstac. It wasn't readily accessible.
Exactly.
And now Paperstac made mortgage debt really accessible, and now we're seeing it where it's like, hey, look, there's other kinds of debt out there. There's business debt, and now it's people on Main Street can come in and buy, participate in buying into a business.
Absolutely.
And doing that and not having to do the 9 to 5 or more than the 9 to 5. Usually it's the 6 to midnight shift of working the actual business. They can just find the businesses they like, buy into them, and say, oh, this is a great area to park my money.
And back to the key at the beginning we talked about isn't just diversifying. I mean, if someone's already got a portfolio of mortgage notes, like, well, add this and see how that goes as well. And they'll see how it goes.
Well,
it's going to perform.
Yeah, that's interesting because there's, let's say, a downswing in the real estate market, but that's okay. I'm diversified a little bit over here. Now I have some business. This business, the small business, has been going great. I'm okay. I'm picking up the.
It's interesting because whenever we started doing this, it was like, hey, we got into it, we were doing it, and then people were learning about it, like, oh, I really like this. And then you would find people that would say, I really want to, I'm all in, I'm going to get in there, I want to do the due diligence, I want to buy it. And then there's other people who are like, I really like the idea of it, I just don't want to do it.
Yeah.
I'll give you the money and you do it.
Yeah.
And so those opportunities are there now.
Right.
Jumpstart's got a fund. You can say, hey, you can buy the loan.
Yeah.
Or, hey, just give us the money. We're going to do it already.
Yes.
And that's a great opportunity, I think.
For sure.
Because at the end of the day, some people are just, they like to get into the weeds and do that kind of stuff.
Yeah.
And then you've got people who are, professionals, doctors, lawyers, stuff like, they're like, you do it.
Just looking for a return.
I see that you know what you're doing. I like the investment class. You know what you're doing. You've got processes.
Yeah.
You've been around. Take the money. I'm comfortable.
That's exactly right.
And to add to that, it's a good point about what type of investor they might be. Do they want to be the mum and pop investor that say, well, if I buy a mortgage note, there's a lot of that around, but then how do I service it? I've got to go and pay this company to do this. Right. And whereas with what we're doing, it's we can do all that for you, and it's just here's your return. Here's your just money going into your account every month, and here's your P&I payments, so to speak, right?
Yeah, and you make it, absolutely, and you make a great point on, I don't want to, like I see what's happening, but I don't want to go out and buy a business and operate a business and get my returns, but I want to ride the wave, so to speak, of what's happening. And so with, private credit growing like a weed, democratization, the Main Street private credit now, think about this from a buyer's perspective or from an operator. Somebody does want to run the business. They do want to get out of their corporate day job that they hate. They want to go and have a business. Typically, depending on the price of the business, they're going to be kind of relegated to going down the road of, well, there's three options, right? Cash or equity or debt. And so, people only have so much cash they want to put into that, whether it's as a down payment or to buy the business, and they want to preserve some personal liquidity typically. Equity is usually the most expensive money you'll ever raise because you're literally giving away a portion of your future success. You might not feel it right away, but you will. And then there's debt, which is, unsecured or secured, collateralized. And so oftentimes when it comes to debt, the SBA 7A program is typically the go-to for business acquisitions. There's guarantees on the banking side that make it appealing to lend to potentially riskier businesses. But it's really, and we say this, it's like going to the DMV. You got to do it, but it's painful, right? And there's literally, in our market, there's a negative demand for SBA. Like, people are literally doing whatever they can to avoid it.
Yeah,
interesting. And when they do, if they do get it, it's pretty good money and it can be a good program. But typically what we hear is it takes forever. There's an onerous amount of documentation. There are typically two different underwriting criteria being applied. There's the SOP from the SBA, and then there's the actual SBA lender itself. And sometimes there are conflicts there that make it all the more difficult and uncertain. And then there's like onerous collateralization, and then there's usually very heavy down payment requirements for the borrower. So if you're a borrower, you're a buyer, you're an entrepreneur, an acquisition entrepreneur, and you can avoid SBA lending, believe me, you're going to be all over it.
Are you going to pay? No. Are you going to have a problem paying a higher interest rate?
No, because
that's how onerous the process is.
Because
with the
the trade-offs are. So if you go the private credit route, and that's exactly what we're talking about here, the ability for us to fund and for investors to be involved at point of origination. To your point, I don't want to buy it, but I want to fund it because I believe in it and it's growing, and I see we can have great returns. We are very much positioning ourselves as an SBA alternative lender. And so that means not only are we originating loans and trying to sell the notes with partners like you guys, but we're also looking for folks that would partner on the front end and either be part of a fund where we can lend directly or, syndicate on deals that come up. Like, I live in Montana at least most of the year. There's I think it's Helena, there's a 100-year-old ice cream parlor that just sold. 72-year-old person retiring, sold it to a 32-year-old guy and his wife.
Wow.
And I'm just thinking, like, that business is just not going to fail.
Right.
That business is with the lowest risk, And so why can't we be involved in that? Don't go to the SBA. Don't go to a conventional lender. Go to Jumpstart, get the capital, and get off and running. And that's a huge opportunity for them and for our investors.
Faster too, isn't it?
Heck of a lot faster.
Less work. It's just an easier process going through Jumpstart than the SBA. I think it's also something to point out is investors were here to make money.
Yeah.
It's like sometimes people will get to where they're like I just need to maximize my returns.
Sure.
And you're like, well, okay, did you maximize the returns by being the guy who's running the business?
Yeah.
And then if you're not going to do that, you're like, okay, the next guy in line who's going to make the most, the guy who's like, look, I'm doing all the work originating the loan. I'm going to do this.
Yeah.
Or it's like, okay, can you take a little bit less and just say, here, you go do it, and
Right.
I'll just give you the money. So there's different levels there, and the risk really comes with, hey, the more risk you're willing to put in, probably the more return you're going to come in.
Sure.
But for the guys who are looking for the mailbox money, or the investors who are looking to say, look, I'm just parking my capital,
Yeah.
it's a great option, is the fund.
Yeah. Well, and exactly. And as you were saying that, I was thinking about another distinction between mortgage notes and business notes is that, mortgage note holders, there's appreciation, hopefully, in that property, an underlying asset, but there can also be depreciation, and it can swing quite wildly, as we all know. The underlying asset, or the engine that's repaying the debt with a business note, is a business that presumably, if you have a strong operator who's ambitious and skilled, and
strong.
that's part of our underwriting, wants to grow that. So the appreciation on the business, it's staying the same, like the mortgage note, or rather the notes being serviced, but the business is growing. So EBITDA, or seller discretionary earnings, is going up, revenue is going up. They're expanding. They're digitizing a business maybe that has like a website that's got a brochureware or something, and you click and you get 404 error, like it's not working. So you've got people coming in and professionalizing and digitizing and growing businesses.
Especially with like AI coming in now.
Yeah.
So the smaller businesses are really able to capitalize on this AI boom, because I'm owning a business note, let's say for the last couple of years, I've been watching the operator do really good, but they're lacking maybe on, whatever it may be, because it's cost constraining, it's too much. But now with the AI, it's going to help businesses.
Yeah.
Yeah.
So it should help with the performance of the entire business, and it's really that uncontrollable variable within the business note space is the market. Like I can't control if the market's going to go up or down with real estate. You're saying with the variables about the business note is it's a business owner. Hopefully they're able to control how that success happens, right? That appreciation isn't there with like the property.
The assets per se,
but
right.
I'm able to, if you stop working and you're sleeping on the couch and like not working anymore on the business, that's going to happen, right?
Exactly.
So that's interesting, because it's one of those variables when you're investing in something is, what do I have control over? What do I not have control over? How do I mitigate that risk that I don't have control over? And with business notes, it's interesting. That's just coming to my head of like, wow, that guy, he's able to control that.
Yeah, largely,
Add on what you said earlier about, right now we just talked about buying a business note that's already established, buy the note, away you go, right? But we can also come to the source, which is what you were talking about. If you've got someone over here that's wants to invest their money, and we've got someone that's wanting to buy a business, we can marry these two up, and actually someone may specify, I want to be in this type of industry. So you might have an investor that says, I really want to invest in trade type businesses, for example, HVAC, electricians, whatever.
Sure.
Then we can massage and do that, right? Instead of just find me one of those after the fact, it can happen in real time, and they're part of it at day one. And which sort of leads into this, like, I think about this in three sections. There's an investor today could invest in a loan that's already established with a business, do it at inception and go, well, okay, we're actually going to underwrite this, and I'm going to choose the business I want, and I'm going to invest the money. Then the other one I know we've touched on, you guys can go into this deeper if you want, which is part of that seller note part as well, right? So because this does happen, you talk about an SBA alternative, we also want to be a seller note alternative. Get into the ground level, but we know what happens. There's businesses out there that the buyer comes along and the seller does his seller financing, and they've got an agreement together, right? And we want to obviously help that right at the beginning as well, and do better underwriting at that time. But that is out there where we could potentially come along and purchase some of those seller agreements.
Yeah, I mean, because that's a big thing. The first panel at the conference today was Fred and Tracy talking about, they do seller finance. I mean, that's their business, is buying seller finance stuff. And
Yeah,
it's like
exactly.
the seller financing side of the business, because I know we worked on a couple deals that, you know, it's working through. And there's a lot of nuances that you're seeing that are going on with this. Is the person that's like, you know, buying the seller finance note or underwriting or going to hold this, there's a lot of misconceptions around, like, well, you might have to take a haircut in the beginning to sell it, the liquidity. So there's a lot of stuff that goes into it. But when I know, talking to like business brokers exploring this asset class, and they were like, wow, that's like huge, this seller finance opportunity, because you can bolt it onto a lot of different things.
There's no
Because the
doubt,
SBA 7, right? Isn't there always this type of seller finance component to that, like a 20%?
It doesn't have to be.
It doesn't have to be.
It doesn't have to be.
I think there can.
They
There
can be,
can
but
be.
they're in typical last
But
position.
it's just, man,
Yeah.
the talk about like you're buying a business note, you're like, I kind of want, for me, and it goes, I guess it's the same with mortgages. You got if you have somebody who is structuring and making the mortgage note or the business note right up front on a seller finance note, fine.
Yeah.
But really, the guys who are doing it professionally, it's like, yeah, those are the loans that I'm looking at. Like,
Yeah.
those are the ones that, you know, honestly, those are the ones that'll take less of a haircut.
Yeah.
Because
Absolutely.
you can, what Eddie, you only bake the cake once. So if you don't bake it right the first time,
Well, that's the important part of
Is
you guys.
correct.
That's another role that Jumpstart does play, is meeting with these people and say, yeah, you can hold some financing on this, but you better bake that cake.
You better
properly,
do it right.
do it right. And there's that whole other aspect to it too, I think, that investors can participate in as well, right? I mean, it's
Yes, I think it's a really exciting opportunity, because we spoke to a major business broker recently. We have a partnership with them, and they've got multiple offices around. You would know if I named them. But, you know, they talked about, like, in one state, they had done last year, 350 deals, but multiple broker offices and so forth. And 85% of them were seller financed or partially seller financed.
Really?
And only 15% of them truly went SBA. And the reason for that is often, again, the negative demand for SBA, like, let's avoid it if we can. And then oftentimes just they don't qualify for SBA lending because there's quite a high bar and excluded industries and, you know, whatever. There's a whole bunch of excuses. So, but the opportunity there with a properly structured, underwritten seller note, underwritten as if it were a bank loan.
Okay.
You know, let's make sure the business can cash flow and can cover the note. Let's make sure the interest rate is at market or above market so it can be sold on the secondary market. Let's make sure there isn't a huge onerous balloon 3 years down the road that any investor is going to not want to buy, because, you know, it's putting the buyer, the operator of the business in a tough position potentially. And then let's make sure there's a servicing history, so there's a proper paper trail, and you're able to see that it was serviced on time and that the note was seasoned. So there's a secondary market. I would argue it's a emerging, burgeoning secondary market for properly originated, performing seller notes. And what I think the key is in the industry is if you get sellers confident that what they're doing is really actually bridging, it's a bridge loan more than it's a seller note they're going to have to carry.
Yes.
If you get them confident that, hey, I'm only going to have to carry this for 3 to 6 months. By the way, while I'm carrying it, I'm getting mid-teens plus interest. So
And you're there to help the guy succeed.
and you've got skin in the game.
That's the beauty of it. Like, we
And-
were just talking about loans. I'm like, how great is it when you're investing in something, but you know the person that's selling it to you has skin in the game?
Yeah.
A seller of a business has that skin in the game.
And you know that you're not going to be able to cash out unless, hey, did you pay the seller note this month, by the way? You know,
Exactly.
Is that a thing? Like, I know, like in the mortgage side or single family residential, it's like, hey, if you're going to owner finance it or seller finance it, use an RMLO.
Right.
A residential mortgage loan originator. Somebody who's, hey, look, I'm going to go make sure that it's underwritten, if they're getting the disclosures, generating the proper paperwork. Is that something, like, if somebody brings a deal to Jumpstart and they say, hey, look, this deal, we're selling it, I'm just going to do owner financing on it, and do you say, look, okay, for a fee, we'll originate
Yes.
this loan and make sure it's done properly.
Exactly.
Oh, by the way, we can also do the servicing on it and get this structured and
Yeah.
ready. So that is a suite of services that you guys offer.
Yeah, we really push that. And when we started talking, that's going back 2 years ago or so now, we started approaching folks that were already carrying a seller note and had originated it. And we said, well, maybe you can cash out. The problem we found with this, and I think because we looked at a few notes, is it was back of the envelope, back of the napkin stuff. It was
none of the numbers. I remember
Yeah.
none of the numbers on one of those
Yeah, that's
deals.
generally
I was
the
like,
issue.
they didn't add up. I was like, nothing here can actually.
And no investor's going to get excited about that. It's
No.
too risky. And so what we decided to do is we pivoted instead to be involved at the point of sale.
Okay.
When the broker is or the buyer and seller are putting the deal together, because oftentimes it'll just be part of the purchase and sale agreement, it'll be part of the closing docs, there'll be a promissory note. We want to make sure that it's actually a note, it's an actual, as if there were loan docs associated with it. We've got all the right disclosures, as you said, we've got the personal guarantee, we've got any collateral associated with it. We set it up in servicing with ACH both ways, all that stuff. So it looks like a bank loan, even though it's a seller note. The seller is the bank. And in a way, the seller is the bank, and then the secondary market is whoever's buying it from the bank. That's the way we want it to look, so that an investor can really get comfortable. And what I think, we have this vision that we could basically completely supplant conventional lending with seller financing on these deals.
Wow.
If you do it right,
Wow.
Yes.
and you're getting 10% returns as a seller,
Yeah.
it's like, look, I want some money. Give me a big chunk up front.
Yeah.
But also, I gotta park the money somewhere, and if I can get some interest
Yeah,
and hold it
exactly.
for 6 months, I'm gonna be selling it for higher. It also I feel like it makes it so where the sellers, you might be able to sell your business even at a little bit of a premium if
Yeah.
you can offer seller.
That's a great point.
seller financing.
Yeah.
It's like, hey, for the guy, I got a premium on this,
Right.
and I'm collecting some money, and along the way, now I'm getting that 6, 8, 10 months of income coming
Sure.
in, but also now I've got something that said, look, that's a performing loan.
Yes.
I can sell it now.
As a business
Yes.
owner, I'm buying a new business. If I can go, dude, can you stay on for like 6 to 12 months so I know what I'm doing here? That's what you're essentially doing. That seller's going to be on there, and you're able to ping that seller
Yeah.
and go, dude, I just went through month 2. Like, what happens when such and such and such? And
Right.
you're like, I'm right there with you. I mean,
Yeah.
so it's like, it's that lifeline to that new business owner that may not jump off the sidelines and buy that business because there's that risk of, I'm by myself now and I don't know what I'm doing. But if there's
Yeah.
that seller finance component, I really see the power in that. And I think that's talking to like everybody at like this conference and other people. It's just as sexy as it is in the mortgage.
Yeah.
I've learned so much over just like from the past couple months of talking and going through and reviewing meeting notes and really being like, that question, why would anybody, what we started with,
Yeah.
why would anybody buy a business note? Like, I don't get it. It's like there's not a house behind it.
Right.
And once you kind of dive in and learn, and just like anything, there's learning, but once you understand it, you're like, oh, I get it.
Yeah,
And now I get why people are like, oh, I would never buy a
and you know
mortgage, so
what?
I'll only buy business.
One
notes.
other
Right.
thing that I'm thinking of right now is diving into the collateral file. Everybody that invests in notes knows the collateral file. That's what you're
Right.
looking at. That's what you're buying. That's like everything. It's a lot with a business note, right? There's a
Yeah.
lot going on. But what do we have nowadays that can comb through a lot of data really quick
AI.
at a really inexpensive rate?
Sure, absolutely.
AI, because the underwriting file that you sent me, right? I'm like, holy cow! I just downloaded the whole thing, put it in chat. Tell me the goods, bads, and the uglies about what am I looking at here.
Fantastic.
But that's a huge file.
Yeah.
In the past, 2 years ago, so I think like kismet, things happen for a reason. Why there's timing. I think the timing on this is just right because there's those tools that the Main Street guy needed, but I don't have I don't have a whole analyst floor. I mean, those files are big. There's a lot going on there.
Exactly.
And I'm looking at them going, and then I go, oh, just chat. Tell me what's up.
Yeah.
And then break it out. Now, I'm in the game, baby. I can buy a business note. I can underwrite a business because I didn't know how to underwrite a business before.
Yeah.
And think about before, two things, right? Back to when you're talking about the advantage of the premium of the seller, right? And so to add to that, which is this business is like pre-approved for this type of seller finance, right? That's that premium they're paying for. Because guess what? We can actually sort of pre-underwrite the business, look at everything, and in conjunction often with a broker, right? And you go, this business, here's this nice little package. So when a buyer comes along, because we're going to put together a proper loan package, even though it's seller financed, and it's all the dot the I's, cross the T's. It's the little things, right? From we're going to pull credit, we're going to look at the buyer's file as though a proper loan is happening, like with the bank, right? So all of that due diligence is done, and the business that's selling, like, hey, it's pre-approved. All we do is the buyer comes on and says, you meet this criteria, you meet this criteria, you pretty much, you'll be able to buy this business, right?
And you'll be able to run models on businesses. It's like, look, I see enough businesses. I know, Great Clips. You go look at Great Clips. You know where Great Clips goes and opens up their new locations? In a Publix shopping. So there's a big grocery store.
Exactly.
Publix. If you go look, and I know my buddy is a general contractor, and he builds those. Does the build outs.
Yeah.
And talking with him, they go, yeah, we just chase Publix around. So you have this modeling, right? Where it's like, hey, okay, I know, this. We're not probably going to put a pizza place over there. There's 4 pizza places.
Right.
Pizza place over here works. You've had the modeling. You've seen it. Then it's really just saying, okay, hey, I know this one's up and running, it's working, it's going to continue to work. We've got a qualified borrower in here. This is a deal.
Yeah.
And I think, this to this point, it's like, okay, great, the seller they're going to get this thing. Who's going to provide the takeout for this eventual exit, right? Because this seller does want to get away.
Yeah.
He's 75. He's like, I do want to go to Cancun, Mexico, and hang out, right?
I don't want to wait another 10 years
I
for
can wait
my
12
money.
months.
Yeah.
If it gets the deal done, it gets me a little more.
Right.
I had to hold some financing. I had to hang on for 6 to 8 to 12 more months in the business, but that's fine. I love the person I'm selling to. We're working, developed a relationship, whatever it may be. Who's going to take me out? That's Paperstac. That's what we want to be, the guys that can, take.
It is. I
take
feel like
that
we're at
person
the
out.
beginning. It reminds me of when we first launched Paperstac, and it was like, oh man, this is huge, and people started just doing deals, and it just started catching momentum and catching fire. I feel like it's been around.
Yep.
Buying and selling debt's been around. Business notes have been around.
Yep, exactly.
But there's also now it's like, hey, look,
Connecting the dots a bit.
you can. Hey, look, here's the pipeline. Here's the outlet pipeline.
Yeah.
There's investors out there looking.
Here's the opportunity, and we don't know any other people that are, have with Paperstac, to toot our own horn, a beautiful site like we have. It's the technology in our space from the mortgage note when we got in it it's archaic. It's doctors' offices and banking. They're all behind the times on this stuff, right?
Yeah.
And it's like when we first brought something that looked really beautiful and developed, and it's like it's the stuff that when you're going into something, a really well-developed site is. The person, for some reason, had a great experience. They don't know why.
Yeah, exactly.
But it's the minutia that Mike, our developer, brings to the thing that he's thinking second level. So I think those things, bringing it all together, is exciting, and I think that there's that timing.
And there's stuff we have right now. There's loans available to buy. There's stuff.
Yeah,
Get
right
out there
now
and
we have
cruise through them.
Yeah, we have an entire portfolio of Jumpstarts. Like I said, I've been trying to field in white glove as many phone calls as I can from investors. There's an adoption process. We all want something to happen tomorrow, yesterday.
Yeah.
I do. I want
course,
this. It's how we make money. It's what we do. It's building this dream, and then everybody adapting. And I think there's going to take some time, but I really. I'm excited about the opportunity, and I just urge people that we have a team here. If you have a phone call, these guys are open to answering
Absolutely.
questions.
We could start doing that, and we could probably set up a webinar really where we're going to have.
Let's do a review.
We've got.
Let's sell some deals.
I mean, we mentioned it in an email, and I think we got like 180 people like, hey, I'm interested.
You bet.
Business
Right.
So
Yeah.
I think probably a good next step is like, hey, let's do a deal review. I love
Yes.
that.
Yeah,
Let's
let's
bring
do
the
it.
portfolio. Let's walk through and let's try to sell one on the call.
Yeah, let's go grab a couple of them
love
and
it.
and
I'm
go
about
Take
selling
the,
stuff.
take the fifth caller. Yeah.
Right, let's go.
Yeah, just go through it and sit down and say, let's dive in and really
Love it.
like, hey, let's analyze this business. Let's tell you why we loaned on it.
Yep.
Yeah.
Why is this
And
deal good?
Why is this
and
a great
it's for
deal?
sale right
and right
now.
now you can buy it.
And your yield is this. That's what they and all the support. All the support.
Yeah, that's
Yeah,
awesome.
absolutely. And that's one of the reasons we love partnering with you guys. Like any marketplace requires a buyer and a seller to be engaged. There needs to be supply, there needs to be demand.
Yeah.
And we all know there's supply and demand for mortgage notes. There's supply for business notes, but the demand is growing, and you guys are helping
Yeah.
to grow that through awareness and education. And the seller note, I think, well, there is supply. Not all of it is the way it needs to look, but I think that we're right on the cusp of building a marketplace here together that's just going to completely disrupt conventional lending,
I can see it
conventional
happening.
acquisition
I'm
So
lending.
you're saying
really
you want to put
excited.
SBA 7 out of business? Is this the?
Well, that would be like trying to put the government out of business,
Yeah,
which
right.
maybe you could argue they already are out of business. But definitely, what I think we need is, there's $6 billion in 7A loan volume last year that was for business acquisitions, and I believe that's just a portion of what we could capture.
Wow.
And that could come from
That's an
Jumpstart
interesting
alternative lending. It could come from seller financing that's then spun into a secondary market takeout, on your platform. And I think that there's investors are part of the equation to make this happen, because as they buy these notes, now we have more available liquidity
Yep.
to lend. So
And and just to add to what you said, remember the scenario we said there was a lot more seller finance with the brokers we talked to than SBA.
yeah,
So think about the number he just mentioned. It's
Yeah.
way more than that for seller
it's-
financing, right?
yeah, exactly. It's
Wow.
a hidden
Yeah.
market, right?
So what I'm excited about, not only because right now we're talking about buying existing
Yep.
notes that are available right now, it's as we do that, it's for the future. Your clients, yours investors that might say, I really love this space. Here's the types of businesses I want to invest in. And then we actually go and find them, the businesses, and that's the beginning part, instead of just waiting till a deal's already done. They can be
Yeah.
part of it right in the beginning.
Yeah, because there is a mountain of untapped inventory, so to
Correct.
speak. It's like
Exactly.
it's been originated, it's ready to go.
Yeah.
Right. So if one of your clients said, I'd like to, for example, I'd like to buy a HVAC company anywhere in the US, doesn't matter where it is. We know there's a broker right now that probably has one for sale, and you go, let's do the seller
I
note,
didn't even
pair them
think
up,
of
and
that-
away we
that-
go.
That network right there that you guys are
That
tapped
deal
into,
flow is
right? That
is
deal flow's-
unbelievable.
Is it?
Yeah.
Is it really just?
Yeah, how
crazy?
easy is it for that broker to go say, hey, I can sell this, and by the way, I've got financing lined up for you if you want to come buy it.
Exactly. And the broker wants one thing, and they're very varying levels of skill with brokers, unfortunately, but they all want one thing, and that is to get to the table to close the deal and make their commission.
Mission check, that's it.
And that's it. So, they know that financing is the long pole in the tent, and then, you can all hear them sigh when they find out the buyer's going to go SBA. Oh dear. Okay, here we go. So what our vision again is to be able to put SB out of business. It's like
Pain
to
points,
say, here we go, solution.
Correct.
Yeah.
Pain
And we're not
point.
just talking a Band-Aid, we're talking, like actual cure, right? Which is use Jumpstart, partnered with Paperstac. We've got a way of originating these loans and selling them on the secondary market. And you can avoid all of the pain that goes with SBA. So
And there's that feel good component too. Why are we entrepreneurs? Why
yeah,
are you guys entrepreneurs? You're involved in, if you can help incubate more
Yes.
people to small businesses.
Yep.
It's
Exactly.
what our country was born on.
that's what's super cool about it.
That's
yeah.
the beauty of it, right? And that's what we want to do. I mean, we want to incubate all that stuff. You don't
Absolutely.
have to, mortgage notes. You don't have to go to always a bank. Hold
Yeah.
some financing.
Hey, let's
you
go
become
help
a bank.
somebody
You don't have
out.
to be a Wells Fargo or
Yeah.
what have you. We're not sponsored by Wells Fargo,
No.
so it's just,
So
Yeah.
awesome.
Great.
Grant,
Thanks,
Nate,
guys.
thank
Yeah.
you guys.
Awesome,
That was a
man.
good talk.
Appreciate
Look
your
forward
time,
to
guys.
it.
Let's
Keep
do
the
it.
ball rolling. We'll
Yeah.
catch you guys on the next one. That's it for the Paperstac Podcast. Really a lot of good stuff here. A lot of good stuff. Stay tuned. We'll have more episodes coming out. This was good, man.
Yeah.
Thank you guys.
Thanks for your
Appreciate it.
time.
Awesome.
Thanks, gang.
All right, thanks.
Thanks, guys.